Welcome everyone to today's financial reporting update webinar. My name is Raisa and I'm joined today by Anthony, who's a familiar face, and we've also got Vanessa with us today, who's going to be helping out with some questions. And we are all members of BDO's corporate reporting team. So we have quite a jam-packed agenda today, and we expect today's webinar to last approximately 55 to 60 minutes. Just some housekeeping before we get into it. If you'd like to ask any questions, please use the Q&A function, which you can access from the icons at the bottom of your screen. Time permitting, we'll try to answer the questions during or at the end of the webinar, or we'll get back to you after. Note that if you click the option to ask your questions anonymously, then we won't be able to contact you after the webinar. A recording of the session will be made available, and this webinar is appropriate for CPD self-certification, and you can self-certify with your company. All right, so that's it for housekeeping. Today's session, as you may have seen from the invite, is dedicated to looking at the new revenue recognition model under FRS 102. Now, as a reminder, the effective date for these new requirements is financial years beginning on or after the 1st of January 2026. Now, we could really talk about the new requirements and the new model for hours, and you will likely encounter numerous application issues as you start applying the requirements in practice. The purpose of today's session is really to provide an overview of the requirements, and then we'll delve into the specific issues as they arise in future sessions. So if we move to the next slide, we can see our new model. Now, the revisions to Section 23 bring a more detailed approach to accounting for revenue using a 5-step model. It's largely converged with IFRS 15 and contains significantly more prescriptive and precise requirements in comparison with the previous Section 23. So this may mean changes in the timing and profile of revenue recognition for some entities. Revenue will now be recognized when or as control over goods or services are transferred to the customer. This is in contrast to the previous Section 23, which was based on an analysis of the transfer of risks and rewards. So let's have a look at the new 5-step model as it's illustrated on this slide. The first step is to identify the contract with the customer. Now, a contract usually creates enforceable rights and obligations between a vendor and its customer. Once you've identified the contract, then in step 2, you need to identify the term performance obligations, which is really just what are the promises that you've made to the customer in the contract. In the 3rd and 4th step, a vendor determines the transaction price of the entire contract and then allocates that transaction price among the different performance obligations that they've identified in step 2. And then in the fifth step, the vendor assesses whether it has satisfied those performance obligations over time or at a point in time and recognizes revenue in accordance with that. And so now we're going to delve into each step of the model in a little bit more detail, as well as looking at some examples. So if we look at the next slide, we're starting off with step 1, which is identifying the contract. Now, a contract with the customer in the scope of Section 23 is in the scope of Section 23 when the contract is legally enforceable and meets the criteria that are listed on the slide. So the first is that collection of consideration must be probable. Rights to goods or services and payment terms should be able to be identified. The contract should have commercial substance, and it should be approved, and the parties should be committed to performing their obligations. Now, the collectability criteria is included as a gating question up front, and it's really designed to prevent entities from applying the revenue model to problematic contracts and recognizing revenue and a significant impairment loss at the same time. So for routine contracts, we don't expect this to be an issue, and we expect this criteria to be met. Another thing to consider is where you have a master or a framework agreement in place. So these are sort of overarching agreements, and often they don't represent a contract for Section 23 purposes because they don't specify the individual goods or services provided. It's likely that in those cases, it's really the individual POs or the invoices that represent the contract for the purposes of applying the five-step model. Another consideration in step one is where they have multiple contracts with the same party and whether those should be combined. So let's look at an example of this. So here in this example, we have software company T, which enters into a license agreement with customer Y. A week later, in a separate contract, T agrees to provide consulting services to ensure that the software can function in Y's IT environment. The consulting services are offered at a discount as a result of customer Y having already entered into a licensing agreement with T. And the question here is, should company T combine its contracts with customer Y? Now, there's some specific guidance in Section 23 that states that an entity should combine two or more contracts that are entered into at or near the same time with the same counterparty if certain criteria are met. So only one of these criteria need to be met. And it talks about the fact that it asks, are the contracts negotiated as a package with a single commercial objective? Is the amount of consideration paid in one contract dependent on the price of performance of another? Or do the goods and services promised in the contracts, in effect, really represent a single promise or a single performance obligation? So if we look at our example and these criteria, we can say, yes, the contracts are entered into near the same time and with the same counterparty. And the pricing of the contracts are dependent on each other, and they're negotiated with the single objective, which is to ensure that the customer can use the software in their specific IT environment. So in this case, in a very simple example, we would say, yes, these two contracts should be combined. What is the impact of combining contracts? So what would happen is the consideration under both contracts would be combined and allocated to the performance obligations identified, considering both contracts as a single unit of account. So this could change the amount and timing of revenue recognition compared to if the contracts were accounted for separately. So for example, how you split the performance, the transaction price between two performance obligations may differ than the pricing that you have in two separate contracts, and that's could result in a difference. For more complex entities with multiple divisions entering into contracts with the same customer base, consideration will need to be given on how to identify if contracts should be combined. So then moving on to step 2. So step 2 talks about identifying separate performance obligations. A performance obligation is defined as a promise or a distinct bundle of goods or services. Revenue is recognized separately for each performance obligation. So this is really a critical step in our 5-step model.
Köszönöm nektek van webinárta.
Just get really unmute. Perfect. And arguably one of the areas that entities struggle with the most. One of the most significant judgment areas in this step is taking the list of promised goods or services in your contract and determining whether each of them are distinct. So if you've got separate performance obligations, or should they be combined? So there's 2 criteria, as we've listed on the slide, that must be met in order for a good or service to be considered distinct. So the first is that the good or service should be capable of being distinct. So in other words, the customer should be able to benefit from the good or service on its own or together with other readily available resources. So if you've got two promises in the contract and you often, let's say you've got a good and a service like we had with the software and maintenance or installation service, if you often sell those separately, then that can be a good indicator that they are capable of being distinct. The next criteria is that they also need to be distinct within the context of the contract. So can you actually identify these separate promises in the contract? So where a promise significantly modifies or customizes others, or where the goods or services are highly interdependent or highly interrelated or integrated. We have that kind of very simple example of a house. Yes, you may be able to see you're going to do the floors and the doors and the windows, but of course they all significantly modify and very are dependent on each other. So in effect, you have one promise rather than several different promises. But significant judgment may be required to apply these criteria. The other thing we wanted to just mention in step 2 is the guidance that's called the series guidance that's available in the standard. And that's really where you have a series of goods or services that can in effect be treated as a single performance obligation. So you may, for example, have a long-term service contract to provide cleaning or security services for a year, or you could have a manufacturing contract which says you need to manufacture 1,000 identical units. Now, theoretically, each day of your service contract or each unit of your manufacturing contract could be a separate performance obligation. But that would create a lot of complexity. So the series guidance says, well, if they're basically the same, then you could actually identify the entire service or the manufacturer of all the units as a single performance obligation. Now, we're not going into detail around the series guidance, but we thought it was just relevant for you to be aware that that exists here in step 2. So let's look at an example of identifying performance obligations. So on the next slide, we have telco A, which has a contract with customer G that includes the delivery of a handset and 24 months of voice and data services. Now, the handset can be resold by the customer or used as their personal mobile device. Telco A also does sell voice and data services separately to other customers. So the question here is, how many performance obligations does Telco identify in its contract with customer G? So in this case, there are 2 separate performance obligations. And if we apply the criteria we chatted about on the previous slide, that is because under criteria 1, customer G can benefit from the handset on its own because they can either sell it or they can use it with other readily available resources. So for example, they could get voice and data services from another provider. So it's not that this handset is locked into this network. Criteria 2, the handset and the services are separable in the context of the contract. So they're noted separately, but there's also no significant integration service. So neither the handset nor the service modifies or customizes the other. G could purchase a handset or services from different parties. And so there's no sort of real dependency between the two. And as such, Telco A would recognize revenue separately for the handset and the voice and data services. Now, as we mentioned, the determining whether something is a distinct performance obligation is an area of significant judgment. So on the next slide, we've noted some circumstances which may require additional consideration. So for example, if you have installation and maintenance services that are provided alongside other goods or services, so for example, IT equipment, it can be difficult to determine if these services are distinct. And therefore, you will need to do an analysis to consider the nature of the services and the level of integration and interdependency. So of course, if you've got a very niche IT environment and the installation service is really complex, maybe you get to it being one performance obligation. Whereas if it's fairly simple and you could actually install it yourself, potentially there's those two can be distinct, but it's an area of judgment and requires some additional thinking. We often also see some kind of administrative type tasks. So for example, you may bill the customer up front to kind of set them up on your system, to run credit checks, and there's some setup activities. Now, judgment is required to differentiate between these setup activities, which are often not a performance obligation because they don't transfer a good or service to your customer, versus a real implementation service, which would transfer some type of benefit to your customer. The other area that we see is around free goods or services, like if you offer free delivery or free maintenance services or free telephone support, then those free services may be a performance obligation as they create a valid expectation that the entity will transfer a good or service to the customer. So these are just some areas which may require additional judgment and consideration when it comes to step 2. And now I'll hand you over to Anthony to take you through step 3.
Good morning, everyone. Thank you, Raisa. So Raisa there has covered step 1 and step 2. And if you think of step 1 as being looking at all of the possible performance obligations that we have to think about together, and then we split that into individual distinct performance obligations. Well, steps 3 and 4 do a similar perform a similar exercise, but in terms of the consideration you received. Step 3 looks at what is the total consideration, or the total transaction price, as it calls it, for all of the contract as determined in step 1. And then in step 4, we'll break that transaction price down and allocate it to the individual and distinct performance obligations. So step 3 first, as I said, looking at the entire transaction price. Clearly, we need to look at the terms of the contract, look at our normal practices, and to determine what that transaction price is. And it's the amount for which the entity will expects to be entitled in exchange for all of the promises and all the performance obligations they've promised. So in that way, it's relatively straightforward. It's a straightforward notion of what's the total you're going to receive. But some of the areas of complication we find here are listed on the screen there. Variable consideration, so where the total amount you receive is contingent on certain future events. Time value of money, when there is a significant gap between the timing of delivery and the timing of the cash flow. And what happens when money or asset is money is transferred in the other direction and you pay something to your customer. And each of those 3 I will look at in the subsequent slides. And the other one then, non-cash consideration, and such where unusually you receive something other than cash for a revenue transaction. In those cases, you've got to either the first step is to fair value the asset you've received. But if you can't reliably estimate the fair value of the asset received, you then fall back on what would you otherwise sell this good or service? What revenue would you normally charge for that performance obligation? So the first instance, look at the fair value of what you've received. But if you can't reliably measure that, fair value the promise. What would you normally receive for delivering that promise? But moving on to look at the other in detail. Next slide on variable consideration. So variable consideration sounds complicated, but it's actually really common. You will certainly have things like volume discounts. If a customer buys more than some specified amount over a period, you will reduce the total selling price. Rebates, similarly around volumes. You might have refunds. You might expect that some people will send the product back. And at the most complicated level, you might have agreed performance bonuses. So in those cases, you've got to think, what are the future events? How could things turn out? How will that impact my revenue? Now, we need to make some form of estimate of that total variable consideration. And so what do we include in there? You estimate the amount in the transaction price that reflects the amount on which you will be entitled. So in other words, you make some form of estimate of the amount you'll receive. And the standard offers you two models, either an expected value approach, so that would involve working out the probabilities of different levels of income, and assigning a probability to each of those and working out the expected value overall, or the most likely amount. If there is one, if you look at the future possible outcomes, if there's one which is the most likely, you can choose to use that as the basis for your transaction price. Whatever you do, whichever those methods you apply, you have to apply them consistently. But importantly, there's an overriding restriction here. You can only recognise any revenue which is on variable consideration to the extent it is highly probable that you will receive that amount, and once the uncertainty is resolved. So you go through that process to estimate it, one of the two models, expected value of the most likely amount, and then you run this check. Okay, at any point, I can't be recognising more than it's highly probable I will end up being able to return once the uncertainty is resolved. We see an example on the next slide, please. So here we have company C entered into an arrangement with customer Z to supply widgets. We always use that, but I'm still not quite sure what one is. And we sell them at a fixed price of £1 per unit. The contract includes no minimum purchase quantity. But what we say is we'll give you a volume rebate, or rather company C says they will give their customer a volume rebate. Total sales in annual period exceed 500, then you will get a rebate of 0.1 for every item purchased in that year. So we then need to think, what is the future we expect? We might go for an expected value, or we might go for the most likely amount. But using that, whichever process is appropriate, they've estimated that Z will purchase 1,000 units in the year. So we do expect to reach a level where our revenue will be limited. So we need to incorporate that into our determination of the overall transaction price. We think it's got a high chance of that happening, so at 80%. So we estimate the transaction price to be 0.9 per unit. We expect to have to give that rebate. So in that case, we'd recognise 90, and for the initial sale of 100 units, even though at that point they will have paid us £1 per unit, we do expect to have to give that back as a rebate. So it's not highly probable we will keep the whole 90. Moving on then to the next of our detailed considerations around transaction price, namely the time value of money. Now, the rules are slightly different for whether you expect to receive the monies after delivery of the goods or services, or whether you will be receiving the monies in advance of your delivery of the goods or service. If it's a deferred payment, first thing you do is consider whether these are just normal business terms, or we are charging an interest rate that's not a market rate. So we look to see, in other words, are we providing some kind of financing component in there? If we are, we got to adjust the amount of consideration for the effects of that time value of the money, and we discount that amount back using a market rate of interest. There is a de minimis. If we expect to be paid within 12 months, we are not required to make that adjustment for the time value of money, but we may if we wish. If it's more than 12 months and they're not normal business terms, or we're not charging a market rate of interest on that, we must discount it back at a market rate. If the customer pays in advance, from the outset, we have an accounting policy choice. We can choose to not make any adjustment for the time value of money. But if we do decide to do that, well, we do it in reverse. What we're going to say is that part of what we've received is effectively financing for us, and we will then recognise an interest expense in reverse. So if it's deferred more than 12 months, we must account for the time value of money if we're not already charging them interest. If it's less than 12 months, we have a choice of whether we do or not. If they pay in advance, we can choose to ignore the time value of money completely, or we can adjust accordingly. Moving on to the next slide, please. And this is when the supplier makes some form of consideration to the customer. So whenever a supplier pays money back to its customer, you've got to consider in the first instance, what is that for? It is either going to be some form of reduction in the transaction price, or it's a payment for distinct goods or services. And that really is a matter of fact. So for it to be a distinct goods or service, you must be able to identify them. You must be able to see that that customer is actually delivering something to you, something different, unrelated to the thing that you are delivering to them. Only then would you consider it an expense. But generally, it's going to lead to some form of reduction in the transaction price. Now, this might be things like coupons, vouchers. It might be things like if your customer is a retailer and you're providing some money to help them with the marketing of your products, unless that is a complete distinct good or service. So, for example, just paying for it to be on a particular shelf, it's not a distinct good or service. You're going to lead to a reduction in the transaction price. See that an example on the next slide. So manufacturer contracts with a retailer to deliver goods. What that retailer does is it also gives coupons to customers to encourage them to buy those specific goods from manufacturer M. M then agrees to reimburse the retailer for any of the coupons which are redeemed, because the retailer will be receiving less. So the manufacturer says it will pay for that shortfall. Well, what you need to do is consider, was any distinct goods or services provided? No, it was just an adjustment to the amounts they received. We've said we would reimburse from them. So from the moment we've communicated that to R, we should consider that to be variable consideration, and we should adjust accordingly. So that's step 3. Let's move on to step 4 on the next slide, please. So we've now considered some of the complications about determining the entire transaction price. We now look back to step 2, where we identified distinct performance obligations, and now we need to take that full bundle of revenue of consideration and allocate it to each of those performance obligations. That's what step 4 is doing. So where there are multiple performance obligations, we need to find some way of splitting that revenue amongst them. So how do we do it? Well, we need to consider the proportion of the total amount to allocate to each performance obligation. And we can do that by determining what is the standalone selling price of each of those individual performance obligations or promises. Now, it might be those standalone selling prices are clear to us. We might, in other situations, sell them discreetly, and in which case, there we go, that is the standalone selling price. In other cases, we might not actually sell that product ourselves. It's met the test of a distinct obligation at step 2, but we don't have our own selling price for that. Well, then we need to try and deduce one. This means us making an estimate based on all relevant kind of market factors about ourselves and the customer to try and determine an appropriate price. But it might be things like determining what our costs will be and applying a market margin to those costs. It might be looking at what competitors charge, maybe looking at what competitors charge, but adjusting for the nature of our product, which might be less, might be superior or inferior to them. So we've got to just come up with a process to estimate using whatever market information we have available. It might be that there is an item in that bundle of promises which you can't reliably measure a distinct selling price. And you can, in some circumstances, use a residual approach and just say, well, what's left, I'll allocate to that. But that should really be seen as a very rare event. But take the full amount now. Work out the proportions representing each of the different selling prices and use those proportions to share out the total transaction price, as we do on the next slide with an example. So Bluecoat offers smart TVs and streaming services to residential customers on contracts, standalone contracts at a price of £120 per month for 20 months. If we look at those two performance obligations, they might deliver to other people the TVs without streaming services, and they might deliver streaming services for people to use on their own TVs. So they've determined that these are separate performance obligations, and we can see that because they sell each of those separately. Well, let's use then those standalone selling prices, which we have from our other customer relationships, to apportion the total amount. So TVs are sold separately for £980. So that is observable evidence of the standalone selling price. And we also offer 24-month contracts without TVs priced at £96 a month. So we've got £980 for the TV. Over 2 years, the total amount for the streaming would be 96 times 24, which is 2,304. So we need to allocate the amount we're charging, 24 times 120, according to those two standalone prices. And that's what the table at the bottom is doing. So in the second column, they are the selling prices. If we look at their relative size, that's a 30 to 70 ratio between the two. So use that ratio of 30 to 70 to share out the amount we're actually charging under this contract of 2,880. That means we'll allocate 30% of the 2,880 to the TV, which is 864, and 70% of that to the streaming service, 2016. And what you can't do is effectively allocate all the discount to one of the products or the other products, or come up with some arbitrary split between them. It has to be based on this kind of systematic approach of taking the total amount and sharing it in proportion to their relative standalone selling prices. So that's step 4. Let's now move on to the final step, step 5. Well, where we've got to now is we now got a list of distinct performance obligations, which we know we need to deal with separately, and we've allocated the top part of the total transaction price to each of those. So now in terms of recognition of revenue, we now look at each of those separately and said, when do we deliver that good or service, that performance obligation, such that I can start recognizing the revenue I've allocated to that. So we start recognizing the revenue on a performance obligation basis. There are two main models, or two main approaches. You're either going to recognize revenue at a point in time. All of that individual performance obligation revenue will be recognized at a single point, or the revenue related to that particular performance obligation will be recognized over time. And the way the model works is to look at the overtime first, and if it meets that criteria, apply over time. If it doesn't, you fall into point in time. So let's, on the next slide, then look at that test on when is it overtime. So you transfer overtime if one of the following criteria are met. Firstly, the customer's getting the benefit over time. So the customer simultaneously receives and consumes that benefit as we perform, as we are delivering our service. And the example there, routine recurring services such as a cleaning service. It might be to provide cleaning services over a year, but as you're doing it, they're getting the benefit straight away. So that should be spread out over the period. Similarly with things like if you have a decorator and they come to decorate your building and their time spreads over their year end. They will recognise some of their revenue before the balance sheet date, because they'll be recognising some over time because you are getting the benefit, and they'll recognise the rest in the next period. That's when this really matters, is when you get period ends in the middle. What do I need to recognise in which period? Similarly, but about the delivery of an asset, it is criteria 2, which is about when the entity is creating or enhancing an asset that the customer already controls. So an obvious example is construction. If the entity owns the land and they call you in to build a property on their land, they've got control of the work in progress as you perform it. So you can recognise revenue as you perform it. Similarly, if you were doing an extension to an existing building, you've got a promise to do the entire extension, but when you're halfway through, you've enhanced their asset, you've enhanced their building, and they have control of the WIP, you can recognise revenue. The third example is a little bit more nuanced, and this is where the work you do and doesn't create anything of use to you. It's not creating an asset that you can use in some other situation, but you do have the enforceable right to demand payment for the work to do. This is often applied in professional services, businesses like our own in audit, or moving on to the next slide in this example, management consulting business. So consulting firm MC enters into a contract to provide some form of professional opinion to their customer A. In these cases, you look to the terms and conditions in the contract, and what it says is, if the customer terminates the contract, other than for protective rights such as the consulting firm's failure to perform, well, if they terminate the contract early, then the contract stipulates that the customer must pay the management consultant for all its costs to date, plus a standard profit margin. So what would that management consulting business do? It would go through those 3 criteria to see, does it meet one of them? So in the first one, which was about, does the entity simultaneously receive and consume the benefit? Well, no, if the management consulting business is only halfway through developing their opinion, doing their research and analysis, there's nothing with their customer. So it hasn't enhanced anything they have. Sorry, they haven't consumed the service yet. Neither is it creating an asset for them, which they already control. It's on the management consultants' files, computers. It's not enhancing anything already controlled by the customer. So then we move to criteria 3 or situation 3. It's not creating an asset that the management consultant firm can use elsewhere because it's specific to this entity. So there's no alternative use for that report. That's the work it's done. But because we've looked at the terms of the contract and they say they have the right to receive compensation for the work done to date, it's meeting the 3rd criteria. So then this is another example of where over time revenue recognition is appropriate. But what about when it's not? As I said, the way that standard works is run these tests, and if it passes, it's over time. If it fails, it defaults to point in time. So on to the next slide, please. When do we recognise it on a point in time? Well, it's always about when the customer, has obtained control of that promise, of that performance obligation. When have we satisfied that individual performance obligation fully? Raisa said earlier on, we used to be on a risks and rewards model. We're now on a model about the transfer of control. And it's this distinction that led to the biggest differences in the past when IFRS preparers moved The old model for them was a risk and reward model. When they moved to IFRS 15, this was the one that needed the most careful consideration, alongside the unbundling of multiple performance obligations. But this needed careful consideration to determine there would be times where you might have transferred risk and rewards, but you hadn't fully transferred control. Now, there are some indicators to help us with that. Legal title might suggest you've transferred control. It doesn't necessarily. That might only be some example of a sort of protective right. They still aren't able to control the underlying asset. Wait, if you have a present right to payment, you would have thought you would only have a right to payment when the entity has got control. Why would they commit to be able to pay you? So it's an indicator, but it doesn't prove for certain that control sits with your customer. Has the asset been accepted by the customer, and they now have said, yeah, we have it, we accept, we control it. Physical possession would indicate that they do, but again, there might be ways in which you can take it back. So none of these are in themselves definitive, including their risk and rewards is an indicator now. We haven't abandoned it completely, but it's no longer a definitive mark. It's no longer definitive that the risk and rewards of ownership have transferred. You must have transferred control. So that's the five-step model for the revenue recognition. Decide what your contract is. That might involve combining two separate legal documents because we've met the criteria for thinking of this as one contract. You've then got your bundle of performance obligations, which you need to break down into those which are distinct and separable. You then determine what your total transaction price is, the total revenue you expect, taking into consideration things like uncertainty and variability, and then split that amongst that list of performance obligations. Then on a performance obligation, by taking each one in turn, you determine the time to recognise revenue. That will drive your income statement, but there might be some impacts on your balance sheet, and some of the balance sheet items you'll be recognised will be different to previously. So we can just move on to the next slide, please. What we need to start talking about is the contract costs of delivering these revenue transactions and the impact on the balance sheet. So taking each of these in turn, first, the cost to obtain a contract. You can capitalise certain costs to obtain a contract onto your balance sheet rather than when they're incurred. An example of this is sales commission. This now becomes part of the cost of a contract rather than something which you probably have expensed in advance before now. You can only recognise it if certain criteria are met, and these are that you've only incurred it because you've obtained the contract. That's the case for something like a sales commission. You'll only need to pay that if you've won the contract, and you expect to fully recover those costs under the contract, and you'll generate enough revenue. In those cases, you can recognise an asset. You can recognise some other assets relating to cost to obtain, but that's only if there's an explicit an explicit commitment in the contract by the customer that they will recover those costs, even if you don't obtain the contract. And you can also capitalise those. Costs of fulfilling a contract. These are the costs which you need to incur in order to satisfy your performance obligations. Normally, you will recognise these in accordance with other sections, such as inventories. But if it's not within the scope of other sections, again, you can recognise this as a separate asset. It only though if what the costs you incur directly relate to resources you'll generate from that contract in the future, and it's likely you will generate enough revenue again to cover those costs. You won't make a loss on them. So these are giving stricter criteria on some relevant costs, but under certain conditions, they're leading to the recognition of new balances that you might not otherwise have recognised. So in total on your balance sheet, though, you will get now either a contract asset or a contract liability. And these depend on the relationship between what you've done for the entity and what they've paid. Now, clearly, if they're paid in advance of you delivering, you have a contract liability. If you've incurred work and performed services for them, recognized revenue, but you haven't yet received any benefit, you will have some form of contract asset. Importantly, there's a distinction here between a contract asset and a trade receivable, but it's because obviously with a trade receivable, that also arises when you've done the work but not yet been paid. The difference between the two is it's only a contract asset while you're in a period where there's still more for you to do before you can build them, but you have done something. So, for example, you've built part of that extension, you've agreed with them you wouldn't build them until some particular milestone is met. So you can't yet demand payment, but you can recognize a contract asset for the work you've done. When you get to the point where it is now a right to the cash, it flips to be a trade receivable. So the balance sheet simplifies to just contract assets or contract liabilities, but you've just got to be careful about the distinction between a clear contract asset and an actual trade receivable. Final slide from me, please. Moving on. Is just for you to think about some of the practical consideration of everything you need to do. You can lump together similar contracts, but you've got to make sure you do that carefully. You can only put them into the same bucket, if you like, for your analysis, if they've got similar terms, similar conditions, similar characteristics. But it's worth doing that for the overall analysis of what kind of distinct obligations are arising in our individual contracts. Need to think through whether the variable consideration to determine which approach you're going to use, that expected value or the most likely. Those and changes from, for example, from transfer of risks and rewards to control as a test may well lead to changes in your revenue recognition. You need to think through how is this going to impact your KPIs. Who do you need to forewarn of those changes? Which stakeholders? What new systems and processes do you need to identify whether different contracts need combining, or whether how you'll start identifying separate performance obligations? Do you need to start training your finance team to operate this, but also your sales team and your operations team, so that they get an understanding of what the finance team are going to need and can start organising their part of the business in such a way that it gives you what you need. Finally, all of those KPI impacts, revenue recognition impacts, may hit things like contracts you have around performance, based on performance, like employee remuneration, and debt covenants. So think through, if this starts changing my revenue, how's it going to change my profit? How's it going to change all of these contractual arrangements I'm in? What do I need to start doing now to prepare yourself and the counterparties for these changes? Okay, that's all for me. I will now pass back to Raisa.
Wonderful. Thank you so much, Anthony, for that. As you can see, there's quite a lot to think about in applying our 5-step model. And now, in this last few minutes that we have, we're going to just give you an overview of some of the transition requirements of the new section, of the revised section 23. So in essence, entities have the option of 2 methods to transition to the revised requirements. They can either apply the requirements retrospectively, or they can use a cumulative effect method. Now, under the retrospective method, so if we move on to the next slide, the entity would restate comparative information and apply the revised section 23 as if it had always applied. And there are some practical expedients that we'll talk about on the next slide. So retrospective, I've always applied these new rules. The next option is a cumulative effect method, whereby comparative information is not restated and rather the revised Section 23 is applied at the beginning of the current period. So for an entity with a December year end, that's applying it for the first time in 2026, they would apply the requirements at the 1st of January 2026, and they would make an adjustment to their retained earnings at that date for any transitional impact. There are also some practical expedients that you can apply under this method. The other thing you can do under the cumulative effect method is that you can ignore contracts that were completed prior to the date of initial application. So the date of initial application for a December year end would be 1 January 2026. So if you had a contract that was completed prior to that date, you can ignore it. Now, what is a completed contract? A completed contract is one where the entity has transferred all goods or services as have been identified under the old Section 23. So in essence, you've delivered everything you need to the customer. You may still be waiting for payment, so you may still have a trade receivable, but because you've delivered all the goods or services, this would be considered a completed contract. So you can sort of ignore those if you're applying the cumulative effect method. So let's very briefly look at some of the practical expedients that are allowable under each transition method. So on the next slide, we have the practical expedients that are available if you're applying the standard retrospectively. Now, there are 4 of them. You can elect to apply one or all, but once you've elected them, then you need to apply them consistently to all contracts and all periods presented. So the first expedient talks about that you don't have to do any restatement for completed contracts that begin and end in the same year. So if you've got a contract where it's all unwound in the same year and they're complete at the beginning of your earliest period presented, which we'll talk about what that date would be in a second. So if you've got those completed contracts, you can ignore them. Or like we said previously, if they're completed before you apply the standard, you can also ignore them. Now, because you're going retrospective here and you're restating comparatives, that date that you're considering is for a December year end, the 1st of January 2025, because you're looking sort of at your opening balance sheet. So if it's completed prior to that date, then you can ignore it. The second expedient talks about variable consideration, because of course, if you're going retrospective, theoretically, you're going to have to go back and think about how you would have estimated variable consideration in previous periods, which is a bit of a complex, especially because you would now know what the final transaction price is, or some of that variability may well have unwound itself. So for this practical expedient, therefore, says that if you've got a contract that is completed, then you can just use the final transaction price and you don't have to go and sort of rethink about what your estimates would have been around variable consideration. The third practical expedient talks about modifications. Now, we haven't dealt with the guidance in the revised Section 23 around modifications, but it can be fairly complex. So the third expedient says, well, if you've got any contracts that were modified prior to the date of initial application, which is 1 January 26, then you can ignore those previous modifications and you can simply just look at the kind of modified terms and conditions of the contract, and you can then transition that contract based on those terms and conditions. So that's quite a nice simplification, so you don't have to unwind all the modifications that you may have had previously, especially if you've had quite a longer term contract and you've changed it multiple times. The last practical expedient specifically relates to some disclosure around unsatisfied performance obligations and says that you don't need to provide this disclosure for prior periods. Okay. On the next slide, we have some of the 2 expedients that are available to you if you elect to apply the cumulative effect method. Similarly, you can choose to apply one or both or none, but once you've elected them, you need to apply it consistently to all contracts. So the first is around completed contracts with variable consideration. Like we said in the previous slide, instead of unwinding and kind of trying to think about what your variable consideration would have been, you can just apply the standard to the final transaction price. The second practical expedient is around modifications. Again, avoiding having to think about what modifications happened when, and just then transitioning the contract based on the final terms and conditions, or as they stand at the date that you apply the standard. All right. So those are just some things that you have in your pocket, in your arsenal, to kind of ease the burden of transitioning depending on which method you elect. So on the next slide, we have a very simple example that's really just meant to illustrate the difference between these two transition methods. So we have a vendor, which is a music record label that licenses a specific recording of a Beethoven symphony to a customer for a period of 12 months, from the 1st of March 2025 to the 28th of Feb 2026. The customer has the right to use the recording in all types of advertising campaigns in a specified country. The contract is non-cancelable and the customer is required to pay 1,000 currency units per month. The nature of the vendor's promise to the customer is to provide access to the recording in the condition at the start of the licensing period. And the vendor has a 31st of December year end. So the vendor had determined that under the old Section 23, they were going to account for that licensing revenue over time. So they recognized it on a straight line basis over 12 months. Under the revised revenue accounting model, the vendor has decided that, in fact, they should recognize revenue at a point in time. So as soon as the customer has access to that recording, then they've satisfied their performance obligation and they should then recognize revenue sort of upfront. So if this vendor was to apply the standard retrospectively, they would adjust their 2025 comparative figures. If they applied the cumulative effect method, they would have no restatement of their comparatives in 2025, and instead they'd have an adjustment at the 1st of January 2026 for the impact. So if we look at the next slide, we'll put some numbers to that. So under the old revenue model, they would have had 10,000 units of revenue in 2025 and 2,000 in 2026. Recognizing revenue on the straight line basis. If they went fully retrospective, they should have recognized the full 12,000 of revenue in 2025. So they would restate their 2025 comparatives. If instead they decided to go with the cumulative effect method, they wouldn't restate 2025, so they'd remain with their 10,000 currency units of revenue in 2025. And they would have an opening retained earnings adjustment of 2,000 for the adjustment to kind of get their revenue up to 12. Now, the interesting thing is you can see that 2,000 of revenue bypasses your income statement. So we don't ever see that 2,000 in P&L because we've adjusted it through opening retained earnings. And that's just something to be aware of when you're doing this cumulative effect method. And it's the reason we saw some people deciding to go, when we saw this under IFRS 15, people wanting to go fully retrospective, even though that might seem a little bit more complicated. All right. So that's really the end of sort of our very quick whistle-stop tour of the revised revenue model. On the next slide is really just a reminder of what we've covered. We spoke about the 5-step model. We spoke about contract balances, and Anthony took us through some of the practical considerations. And then we touched very briefly on the 2 different transition methods. Now, we're aware that these new requirements can be complex, and you'll likely identify some additional complexities as you apply them, and hopefully we'll cover some of these in future webinars. I think we've had a number of questions in the chat, but most of them have been answered, so thank you, Vanessa and Moses. If there are any that we haven't got to, Don't despair, we will get back to you after the webinar. And when you get the email after this, you'll have the link to the slides and the recording, as well as the questions and the answers that are provided. So on that note, I won't pause for questions because we're at time. We will answer them. We will get back to you. But thank you so much for joining us. And have a good day. Thank you.